I am going to be teaching you exactly what school didn't teach you. Loans. All loans function the exact same way. There are some differences between them. However, if you stay long enough, I will show you the power with loans. Hey, how's it going? My name is Ariel Lafuente. I'm a mechanical engineer, real estate investor, and also mortgage broker. Within my first 2 years, I own and manage a 7-figure real estate portfolio, and I also help first-time homebuyers and also real estate investors when it comes to buying their houses. In today's topic, I'm going to be talking about the origin story of loans. One day, there was an individual that needed to spend money. They needed to ask for someone else to borrow their money, and in return, they're going to pay back the money that they asked for plus a little bit extra. Close your eyes. It is 3000 BC. Let's say you were a farmer that had no seeds and you asked someone else who did have seeds. You made a promise to the person who lent you the seeds that you're going to grow their crops and then you're going to pay them back in terms of the crops that you borrowed and plus a little bit extra. That is basically the origin story of loans, all right? Speed up 5,000 years into the future, you are in today's age. However, things are different. The mechanics have changed, the game is the same. In today's day and age, there are 5 variables that you need to keep track of. You have your principal, you have your interest, you have your term, you have your rate, and you have your monthly payment. The way loans are calculated is by some voodoo magic right here. This is an intimidating equation. However, stick with me. So basically from this equation, you're going to be getting 3 of the variables that I talked and you're going to plug them into the equation, right? So you're going to be plugging in your principal, you're going to be plugging in your interest rate, and you're going to be plugging in your term. With this, you're going to be spat out a monthly payment. In doing this, I'm going to provide an example. So in this example, let's say you borrow $1,000 and you make the term 22 months, and then the interest rate you have is 12%. They plug this into the equation and then you get a certain monthly payment every month. So the monthly payment is going to be $50.86. One of the most critical things that you need to know in terms of everything is how much money are you paying in terms of interest and how much you are paying in terms of your principal. So to determine how much money you're paying in terms of your principal, you get your annual interest rate, which is the 12%, and you divide that by 12 to get a monthly interest rate. So with that, 12 divided by 1, that ends up being 1%. So you get 1%, you times that by the loan amount or the principal balance, and what you're going to be getting is $10. So when you make your $50.86 payment, $10 is going to be going towards your interest, and then $40.86 is going to be going towards your principal. All right. So in the following month, because you paid down your principal balance, your interest payment is going to be less and your principal payment is going to be more. And boom, there you have it. That is everything that you need to know when it comes to standard loans. Now, the most critical part about all this is you need to know what you are sacrificing, or also known as you need to know how much you are spending in terms of your interest every month. Interest is basically the cost of you using money, not your money, someone else's money. Now, I'm going to go ahead and move forward in terms of the takeaways and action of knowing this core fundamental principles. All right. You need to know loans need to be looked at as fire. Right? You can either burn yourself and burn everything around you, or you can use it to your advantage and build a lot of good things. Loans essentially give you money at the expense of paying back whatever you borrowed at the expense of a little bit extra, right? That little bit extra is your interest. If you can take anything away from this video, is this: do not spend money you do not have. I repeat, do not spend money that you do not have. If you are going to be borrowing money and you do not foresee you being able to pay back that money, you should not be even contemplating borrowing money. All right. The only reason why you should be borrowing money is A, it's for something that's going to last you a long time, or B, it's going to be for something that's going to make you money. All right. So what's the flip side of that? It's purely for pleasure, right? And it's not going to last you a long time, right? So you need to make sure that the purpose behind of you borrowing money is for something good. All right. For example, I've seen it time and time again where someone is literally taking out a personal loan to buy themselves something that is very, very temporary, such as a bag or shoes or whatever, and then it ends up breaking or diminishes within a week or whatever. You do not want to do that. There's no point in taking out a loan that you have to pay for 1 to 2 years and it being useless within the first 1 to 2 months. So make sure you're getting the right thing. I'm going to be going over some of the negative parts of getting a loan. There are a lot, right? And I won't be covering them all, but this is a decent gist of everything. Once again, with the loan, you're basically going to be spending money you otherwise would have spent, okay? However, the money that you would have spent because you're using someone else's money, you are going to be needing to pay a fee for borrowing someone else's money. For example, going back to the example that I stated with the 22-month term, 12% interest rate, and $1,000 principal, the cost of me paying back that entire loan amount for those 22 months, I'm going to be spending $119, right? That is the cost of me taking out that loan. So not only will I need to pay back the $1,000 that I borrowed, I will need to also pay back an extra $119. One perfect example of this can be seen in terms of, let's say, getting a super expensive Apple iPhone where you get all the juicy upgrades, right? So you go to Apple Store, you ask for some financing, right? That's another term for loans in today's age. You ask for some type of financing, they give you certain interest rate, all this other stuff. Or let's say you get a personal loan, you get a nice juicy iPhone for $1,000 and you pay $50 a month for it. Keep in mind, you know exactly what you're getting yourself into. Super important. And then another negative about getting loans is whenever you get a loan that is large and a relatively low interest rate, there is some type of collateral in terms of the loan. All right. An example for a collateral on a loan will be a mortgage. A mortgage is basically a loan for a house, and the house acts as collateral. An auto loan is the exact same way. When you take a loan out for a car is a collateral. So if you do not make the payments on time, whoever lent you the money has right to take back whatever you bought with the money. So that is collateral. Usually the interest rates around there, let's say around anywhere between at this time and date, 7 to 12% interest. Now, one thing that you see when there isn't collateral is a credit card. Usually the interest rates, because there is no collateral, interest rates are going to be higher, anywhere between 20 to 30%. Usually when there's not collateral on the loan, you are going to be needing to pay back more in terms of interest. One thing I will say is, yes, credit cards don't work the same way as a standard loan. However, there's fine tuning that is done to basically get the same exact outcome. You get the monthly interest rate and you multiply that by your balance, and that is how much money that is added into your balance. Then you get a minimum payment, but we won't get into that. One bad part about getting a loan is you need to have some type of credit history. So if you don't have a credit history, it's a little bit harder to getting started off. Usually when you don't have a credit history and all that, you need to get a secured credit card. So a secured credit card is basically you come in with your own collateral. Your own collateral is going to be your own money, which is $1,000. So let's say I go to Bank of America and I come in with my own $1,000 collateral and I basically pay interest on the money that I gave them. Yep, it sounds a little bit convoluted, but that's how it works. So I get started with building my credit and then we're good to go. Lastly, one of the things I want to cover in terms of the negative parts of getting a loan is any loan that you take out will be on your record for a very, very, very long period of time. Any loans that you do take out are going to be on your account for the rest of your life. That's the way you should think about it. If you take out a loan, you need to expect to pay it back. I repeat, if you take out a loan, you need to expect to pay it back. Now, however, there are some exceptions. However, I'm not going to get into those. After all these negatives when it comes to taking a loan, I'm going to be discussing the positives when it comes to taking out a loan. Here is where you can use that fire to build an empire. If you have a business plan or idea, taking out a loan is a very, very good tool to help you scale your business. However, the biggest caveat here is you do not need a loan to build your business, right? A loan with a very, very foolproof and bulletproof idea or business practice is going to help you if you don't have too much capital or funds to begin with. Loans are very, very, very good tool. However, they are not needed when you want it. For example, in my situation, I work in real estate. Real estate is a very, very, very unique situation, right? You are telling me I can talk to a bank, convince them to get me a loan to buy a house. Real estate is a very, very powerful tool because usually land is always appreciated. If you go to that same bank and you ask for a business loan, they won't even give you a business loan to invest in their own stock. So that should give you some type of idea on how powerful real estate is. Loans are really, really, really needed when it comes to being able to finance yourself because no one has $200,000 to $300,000 sitting in their bank account. Most people have anywhere between, let's say, $2,000 to $30,000 is sitting in their bank account, and let's say they want to buy a house. When they have consistent income and they have assets sitting in the bank, that gives a lender a good enough reason to lend you money to buy a house. Now you're able to live in your house with your family, your kids, and everything you want. It's all fine and dandy, right? So that's why financing is really, really, really important in today's age. The same thing goes for a car. Let's say you are a contractor and you need to be going to place A to place B on a regular basis. Let's say you don't have a car, but you make a decent amount of money, then you can go ahead and finance a car so that you can make more money. A house and a car is a good example of how loans can really, really help you in the long run. However, cars are a whole nother story, but you need to be very, very careful that you are making sure that you get a cost-efficient car. If you establish your fundamental principles early on and you know what interest rate, your principal, and everything is, this gives you a lot of leverage when you are basically conducting business. You know what is a good interest rate. You go to a hard money lender, you go to a bank, you go to a non-QM bank, you go to all these different banks, and you can basically compare and contrast your different options that can help you make money in the long run. So it's super, super important that you know what loans are and how powerful they are. At the end of the day, you just want to make sure that you know what is a good deal and you know what is a bad deal. That is everything that I have to talk to you about in terms of loan. It is up to you to make sure you get your hands a little bit dirty with the voodoo magic, and you need to know the basic fundamental principles, because the one thing people do not tell you is that the basics will take you a long way. Educate yourself and do everything you can so that you can give yourself the edge when it comes to being successful in life. Once again, my name is Zara LaFuente, mechanical engineer, real estate investor, and mortgage broker. If you would like help in purchasing a home or applying for a mortgage, please feel free to leave a comment or reach out to me. Please like and subscribe down below and leave a comment with your experience when it comes to loans and also your education when it comes to loans. Thank you very much, and you have an amazing day.